Today I bring you more bad news. I'm going to start with more bad news for the home buyers and then go into plunging home sales for certain cities next year. Hey, first off, my name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. If you haven't done so yet, please click the like and subscribe button. It greatly helps out our channel. Second, if you're thinking of buying or selling real estate here in the Bay Area, give us a call, a text, or an email. We would love to help you out. Okay, on to the news. First one, Realtor.com's housing forecast anticipates that affordability will remain an issue in 2023, particularly among first-time home buyers. If you followed the channel, you know my last few videos have been about how home sales have slowed because of these two things. The first one is interest rate. It's no joke or exaggeration that they have doubled since the beginning of the year. The second one are home prices that have remained resilient. Yes, there is weakness there, but even as prices have retreated, it's still not enough to offset this huge surge in mortgage rates. And because of these two dynamics, Realtor.com's 2023 housing market forecast is predicting that affordability, again, will remain an issue for 2023. They said that the rise in home prices will moderate to single-digit yearly pace of 5.4% for the first time since 2020. Home prices rose 8.6% at the third quarter and 14.2% in the second quarter, according to the National Association of Realtors. Now, the question that you might be asking is why? Why is it that with less buyers, there's still, prices are still going up? In fact, this single-digit increase just brings us back to normal levels. By next year, if you were to buy a typical or average home, your monthly payment would be around $2,400. That's another 28% higher than this year. Another 28% higher. Just imagine that. It's easy to see with this increase, a lot of new home buyers would probably not qualify anymore. According to Danielle Hale, chief economist at Realtor.com, compared to the wild ride the past 2 years, 2023 will be a slower-paced housing market, which means drastic shifts like price declines may not happen as quickly as some have anticipated. It will be a challenging year for both buyers and sellers, but an important one in setting the stage for home sales to return to a sustainable pace over the next 2 or 3 years. Higher costs will lead to fewer closings. People talk about this housing market as a bubble, and it's starting to look like that. I don't see it that way, at least not in the same way as what happened back in 2008. And yes, the pandemic had a lot to do with it, but I would argue that it just accelerated the whole process by 3 years. And what I mean by this is that even before the pandemic, the real estate or the housing market was already going strong. We had unbelievable demand and severe lack of inventory, and this was happening everywhere. If you are from the Bay Area, you are most likely aware how competitive our real estate market is. Well, back in 2018, 2019, the rest of the U.S. housing market started to be like the Bay Area. And what I mean by that is multiple offers and bidding wars. What the pandemic did was pushed all these other markets that might not have been so hot to begin with to join the party, if you will. Let me tell you from my own personal experience, when we shut down the whole economy and the tech companies around here told their employees that they can basically work anywhere, I literally had 3 clients that called me up and said they were moving out of California for good. Sell our house and we need a realtor in X city. Can you refer someone? And I gotta be honest with you, I thought this was a mistake and I still think it's a mistake. We were only 2 or 3 months into the shutdown and people were deciding to just get up and leave. The other thing is interest rates. Yes, also interest rates might have had something to do with that or something to do with it, but I also would argue that, again, it just accelerated people's plans. People that might have been thinking of buying 2 or 3 years down the line, all of a sudden, they kind of were like, wait a minute, we could afford to buy a house? Why wait? And add to that, we can buy pretty much anywhere. So to me, these people that bought would have bought anyway, pandemic or not, low interest rate environment or not. So it's not like they were just waiting to buying and not qualified. No, most if not all of these home buyers were already well qualified and ready to pull the trigger, just not during that time. Now, the effects of the pandemic, for a lack of a better word, is tapering down or normalizing. we are starting to return to a more normal housing market. Now, it doesn't feel normal because we've had 2+ years of super low interest rate environment, plus demand that was so high and supply that's low. Now, here's the kicker. Out of that three, mortgage rates, demand, and supply, only mortgage rates have truly changed. Now, I know what you're saying. Wait a second. Everything in the news is saying that the number of transactions is plunging. So why is it that only interest rates have truly changed? It's because these high interest rates are only suspending demand, if you will. You know, those millennials that we keep hearing about, they are still out there and wants to start their life and buy houses. And right after them, there's another generation, XYZ or whatever, I can't keep track anymore. They are next in line to start buying houses again. So these mortgage rate hikes are nothing but a pause. It's not as if all of a sudden we don't have anyone wanting to buy a home anymore. It's not as if all of a sudden inventory of homes are up and more than meeting the demand. No, these things are still an issue. This is why the most recent Case-Shiller index is still showing home prices appreciating, but at a slower pace. In fact, the way they describe it is rapid deceleration. September showed a 10.6 year-over-year increase, down from 13% in August. This is the sixth straight month of decelerating annual home price appreciation. But to put that into context, the index is just below the all-time highs set back in June. If this pace continues on, they said that the index is forecasted to slow by 8% in December and down to 0 by the spring of 2023. Okay, let me just repeat that. 0 by spring of next year, which just means flat or no growth. Now, obviously, this is not uniform, meaning it's not like the whole US market will be like this. In fact, they said some markets will see more notable price slowing and potential declines in 2023, though decreases are expected to remain regional and specific to metro areas that saw relatively more price growth during the pandemic, such as Las Vegas and Phoenix. And I've said this before on this channel, those markets that will be more negatively impacted will be the ones or the markets that also got hit hard during the last housing bubble. And they mentioned specifically two, Las Vegas and Phoenix. I'd add places in Florida here too. And speaking of declines, they said that the biggest decline in sales volumes will happen in these cities. Ventura, California, 29%. San Jose, California, 28.8%. Bradenton, Florida, 28.7%. San Diego, 27.3%. Palm Bay, 18.3%. LA, 15.8%. Tampa, 15.6%. Tucson, Arizona, 14.7%. Fresno, 13.7%. San Francisco, 13.3%. Quick side note, based on CoreLogic September Home Price Index, San Francisco was the only metro area to post an annual drop in home prices, down by 1% year over year. So you see what's happening here? It's not an ideal situation for either buyers or seller. Usually, it's either a buyer's market or a seller's market or equilibrium. But like I have said, we still have demand out there and inventory is still not meeting demand. But the cost to buy is so high that demand is being stifled right now. And I want to keep hammering this point to everyone. Demand is just on pause. Look, like I said, it's not like 2008, so it's not like all markets are going to be down in terms of prices. In fact, Realtor.com is still forecasting that the nation's top 100 markets is still likely to increase next year by an average of 5.4%. Here in the Bay Area, I think we're still going to be very competitive. Yes, to most home sellers out there, it will seem like home prices have declined, but that is only because you missed the top of the market. The reality is that most home sellers are still in a positive equity situation. Now, for sure, not everyone thinks that we are just going to be fine or we're just going to be flat next year. Some are saying that we could plunge by as much as 20%. And the main factor for this is inflation. If inflation remains high, that means more rate hikes, which means even higher mortgage rates, and affordability just gets thrown out of the window. Further rate hikes would also get us deeper into a recession, which translates to more layoffs, and this could eventually lead us to a real home price decline. I think what most experts are believing is that inflation should start going down sometime early next year, and that could signal the Fed's slowing down rate hikes. So there's this expectation of a slower first half of the year next year and eventually probably ramping up around the third or fourth quarter. Realtor.com said that these metro areas could see the sharpest increases: Worcester, Massachusetts; Portland, Maine; Grand Rapids, Michigan, Providence, Rhode Island, Spokane, Washington, Springfield, Massachusetts, Boise, Idaho, Chattanooga, Tennessee, Indianapolis, Indiana, and Milwaukee, Wisconsin. So if you're in these cities and thinking of buying, better do it sooner than later. So as you can see, there is no definitive answer to this is it a buyer's market or a seller's market? Not good for buyers because of the higher cost of borrowing and coupled with the fact that prices are still holding up. For sellers, while true inventory relative to demand is not really increasing, the bottom line is that the buyers of today are not pulling the trigger. So when I get asked when is the right time to buy or sell my house or buy a house, my answer has always been the same. Whether it's a down market or an up market, it's when you need to and you are capable of doing it. Here's one more tidbit that I want to leave you with on why I think there won't be a housing market crash. 2024 is an election year. I don't think anyone has the stomach to let us go into another 2008. I think the government and the banks have learned their lessons from 2008 and that we are better equipped to handle any semblance of a crash. At least that is my hope. Hey, thanks for watching. See you next time. Hey, wait, there's more. If you're thinking of buying or selling, please give us a call, a text, or an email. We would love to help you out. But wait, there's more. Please don't forget to hit the like and share button. It greatly helps out our channel. Come on now. It's the season of giving, so give me some love or likes. Thanks for watching again.